Assalamu alaikum wa rahmatullah. Hello everyone and welcome back to our YouTube channel, My Business Mindset with Amin. Today we will continue to talk about the financial statement. So now we will start to talk about the third financial statement, which is the cash flow statement. So we start with the definition of the cash flow statement. So what does mean the cash flow statement? The cash flow statement is a financial report that details how cash flow entered and left a business during a reporting period. This statement aims to provide a more detailed picture of what happened to a company's cash during an accounting period. Also, the cash flow statement measures how well the company managed its cash position, meaning how well the company generates cash to pay its debt obligation and funds its operating expenses. As one of the three main financial statements, the cash flow statement complements the balance sheet and the income statement. It plays a role as bridge between the income statement and the balance sheet by showing how cash moved in and out of the company. Now we have to know what are the different components of the income or for the cash flow statement, or in easy way, what is the structure of the cash flow statement. So here we can find three components of cash flow statement. We start with the first, the cash flow from operating activities, cash flow from investing activities, and the cash flow from financing activities. So within cash flow statement, we can find these three main cash flow operating or activities. We start with the first, the cash flow from operating activities. So in this section, from activities within the cash flow statement, it include any sources and uses of cash flow from business activities. It means it reflects how much cash is generated from manufacturing and selling goods or providing a service to a customer. We can find within this section salary and wage payment to employees, received from sales of goods and services, income tax payments, payments made to suppliers of goods and services used in production, payment for operating expenses and rent payment, and so on. The second section or component of the cash flow statement is for investing activities. So the cash flow from investing activities is a part of the cash flow statement that reports the cash flow in and out resulting from the investment activities, which means that the cash flow from investing activities provide an account of cash used in the purchase of non-current assets that will deliver value in the future, such as the acquisition, sales of long-term assets like land, equipment, and so on. The third cash flow from financial activities. In this section gives a picture of how a company raises and spends money through the intermediate of issuing stocks, borrowing, debt repayment, and paying dividends. This component of the cash flow statement helps investors to understand the company's financial strength and how well the organization's capital structure is managed. Now we move to the presentation of the cash flow statement. In this statement, we can find two main way or method to show the cash flow statement. So the cash flow statement can be prepared using direct or indirect method. While the two methods calculate operating cash flow differently, but the cash flow from the financing and investing section or activities are the same under the both methods. So let's have a look for the first method, which is the direct cash flow method. So the statement of the cash flows in the direct method uses uses actual cash inflows and outflows from the company's operation instead of modifying the operating section from accrual accounting to a cash basis. Accrual accounting recognizes revenue when it is earned versus when the payment is received from a customer. The cash flow statement in the direct method measures only the cash that's been received. It means the real cash, which is typically from customers, and the cash payment or the outflows, such as the payment for the suppliers. Also, the direct method starts with the amount of all cash received from customers and subtract the amount of cash that has been used from operating expenses, like the payment of the suppliers. The direct cash flow method gives more visibility of the cash in and out in such way that can benefit the company's short-term planning, enabling to identify and analyze potential challenges or opportunities that may exist for the future cash flow. So this table represents the cash flow with the direct method. So we have the cash flow from operating activities. So here we can divide it into two. We have the cash flow in, it means the cash flow received from the customers or other operation, and we have the cash flow out, means when the company pay its obligation toward the suppliers or or for the employees, like salary and wage, or from the authority or government, like income taxes. However, in the second section we have the cash flow from investing activities. It means it's like the operation activities. We have the cash flow in and the cash flow out. Here in the cash flow in, it means the cash flow received from when the company disposal of tangible and intangible assets, or the marketable securities, it means the financial assets, and the interest received. And the cash flow out, it means when the company have an acquisition of tangible or intangible assets, it means when the company here purchase any assets, any kind of assets, tangible or intangible, or financial assets. And in the third section we have the cash flow from finance activities. We have the cash flow in, we have the issuance of stock or borrowing loans, and the cash flow out, we have the repayment of loans and dividends. Finally, we have the net cash flow from financial activities and financing investment. Investment activities and operating activities. That we have in the final. We have the net increase in cash during the year, and we have the cash at the beginning of the year. And now we can calculate the cash at the end of the year. So here it depends what we have as data, but in general we have to calculate the net increase in cash during the year. Now we move to the second method, means the indirect method in showing the cash flow statement. In this method, the indirect cash flow method presents a financial statement that shows the amount of money a company spends or makes in a certain period. It starts with the net income, then it makes an adjustment to get the cash flow from operating activities. Those adjustments include depreciation and amortization, changes in inventory, changes in receivable and payable accounts. The benefit of the indirect method is that allow the company to understand why the net income is different from the closing bank position. So here, as we said before, that the direct and the indirect method that give us the same result, but here the main difference is in the cash flow from the operating activities. In the indirect cash flow method, we will start with the net income. However, with the direct cash flow method, we start with the customers and the real receipt and the real payment for the company. As below, we have the table that represents the indirect method. Here we have in the cash flow from operating activities, we start with the net income, and we have some adjustment to the net income. We have the amortization and the loss on sale of equipment. We have the change in working capital requirement in inventory, accounts receivable and customers, and accounts payable and orders and suppliers. Here we have the net cash flow from other activities, but in the cash flow from investing and finance activities, we will have the same elements as we did with the direct method. So here in this table, we will take a look of what are the differences between the direct and indirect method. In the direct method, we will focus more on understanding money moving in from customers and money moving out through costs or suppliers. But in indirect method, we focus more on amortization and depreciation and treating net income as a single line item. In the direct method, we begin with the cash amount received and paid out by the company. In the indirect method, we begin with the net income. In the direct method, we have not widely used by most company, but in the indirect method, is the most commonly used by the company. It means the company choose to use the indirect method